All right, looks like we're good to go live. Alrighty, it looks like we're here and we're ready to go live. Thank you everyone for joining us. Sorry we're a bit late. I'm here in Melbourne and I've got to admit, it was a kind of nice morning and then all of a sudden, out of nowhere, in the last 10 minutes, there has been some wild weather. So I've just made some provisions for a backup device, so hopefully we don't need it, but you never know. If you can hear me, say g'day in the chat. As always, I'm here to answer your questions. And g'day Vico, Plant One. Always good to see you guys, and thanks for joining again. I think this is at least your third week of catching up and having a chat, so it's great to be with you again. I'm joined by Rob. He's in the chat here with me. If you have any support questions, though, what we would love for you to do is just go straight to selfwealth.com.au, jump on there and hit that instant support feature in the bottom corner there. And if you have any questions around your account or any new features that we're working on behind the scenes, go ahead and do that. Jump in there. I'm here to talk investing with you and hopefully answer some questions. Today, we've got a whole host of things that we're going to be working on. I'll just get up my list here. So the things that we're going to talk about are basically some of what I would say are Warren Buffett's kind of key principles for investing. The first of which is assessing management teams, which is this kind of principle around finding people with equal measures of important ingredients that align with your long-term investing, goals. The other thing that we're going to talk about is competitive advantages. How do we assess those? What are we looking at in particular? And what are some of those that kind of apply to all different types of investing? Then we're going to jump into an analysis of Washington H. Soul Pattinson. So Solpats, for those of you that know it, I think it's the company on the ASX with the longest running successive dividend history. So been listed for over 100 years, paid dividends for many, many, many decades, run by Rob Milner and the family out of Sydney. It's a conglomerate. And I was working through it this morning. They're actually looking at doing a merger through a scheme, and there have been some takeover offers. So we'll dig through all of that. Again, if you have any questions, say g'day and just reach out in the chat. Thanks, Vico, for the heads up. And if we go through this and you have any questions about any specific companies, just reach out. Obviously, I've got to give you my wonderful general advice disclaimer, which is that if I do answer any questions, those questions are not specific to your situation, needs, goals, or objectives. Now, that's important for me to say because I simply don't know what those are, and you need to see a financial planner if you want that type of advice. To learn more about what I can and can't say, you can head to the Rask website, which is www.rask.com.au/FSG, and you'll find our financial services guide there. Cool. So just a bit of a quick intro to me. As always, my name's Owen Rask. I'm the founder of Rask Australia. We've partnered with SelfWealth to bring you investor education and help you become a better investor. I'm an analyst. That's my day job. And I went through this journey of kind of learning how to invest better for about the past 10 years. And my job today is researching companies, but also it is a big part of it is actually interviewing other investors. So I do that. It's one day of my week is just getting to interview other investors and interview CEOs and founders and the like. So great way for me to spend my week. I'm very happy that I've got to this position. But if you need to find out more about me, you can head to the Rask website. Okay, so let's get into it then. One thing I want to actually say is don't forget that update from last week, which was that SelfWealth are running a kind of a trade promo. If you make 3 trades in September, you can get a chance to win 100 free trades. So I'm sure there's more information on the website about that, but you can go and find out about that. Chances are most of you are doing that anyway, so it probably is. You're probably going to go in the drawer anyway. I always want to remind you that live pricing is now available. So that went live last week. That's for Aussie stocks, and instant deposits are also available if your bank is OSCO enabled. You'll know if it's OSCO enabled because when you go into your app and you transfer money around, it comes up with OSCO and kind of this big O. Cool. Okay. So let's get into it. Let's get into the meat of this update. So last week and the week before, we talked about kind of 5 principles for analyzing companies. The first principle was finding companies with strong competitive advantages. Yep, there we go. In the chat, there's a link to the promo. So we've got companies with strong competitive advantages. We've got owner-operators or management that act like owner-operators. We've got companies that are within our circle of competence. So what do we understand and what are we passionate about? We should focus on those sectors and industries first. Then we were talking about the growth in the business and growth in the industry. Obviously, as long-term investors, you want to target companies that are growing, or at least it doesn't have to be super fast, but just growing to some extent. Finally, we talked about valuation and identifying companies that have reasonable valuations. Today, we're going to dig into 2 of those and ask you questions as we go through. So the first thing that I want to talk about is basically this kind of idea around competitive advantage and moat. So I'm just going to bring up my screen here. Let's just jump across. Okay, so here I am on the website, the selfwealth.com.au, where we are inside my demo trading account. So I'm going to just type in a random company. So let's say we're going to talk about, let's go TPG. That makes sense for today. TPG. Oh, not TPG. There we go, Owen. That's the one that we want. Okay. So now what we're doing is, I'm just going to bring this across. There we go. Okay, so what we're doing here is we're looking at TPG. I'm just on the overview page. And one of the things that defines companies that have competitive advantages, and this goes back to back in the day to when Benjamin Graham and Charlie Munger and Warren Buffett, all of these great investors that we know from America were starting out, and they were trying to define what makes a great company. And one of the things that we talked about in the past few weeks is this idea of return on investment or return on invested capital. So you can see here for TPG that it has a return on investment of, for the most recent financial year, around about 7.5%. So that's basically saying for every dollar we invest, we get 7.5 cents back every year, which, as you're about to discover, is probably not that good. But as it grows, as the business grows, it might become more efficient. So you may remember that we talked about Netflix a few weeks ago, where we talked about its margins improving based on that operating margin or EBIT margin. So let's grab another company. Let's go with, say, I don't know, let's go Afterpay. That might be an interesting one. I'm not sure how this will work out because I'm not sure if it's profitable right now. So what the return on invested capital is, I should explain that before I get to it. But what the return on invested capital tells us, and what it is comparing, is basically the operating income or the operating profit. So the profit before we get to things like financing costs and interest, and we compare that to the total capital. So the capital that is deployed by the business. And we're trying to compare how much money is this company investing versus what return is it getting on that money. So we can see for Afterpay, it's actually negative over the past 5 years, the average there. So it's actually not reporting an operating profit. And we know, if you keep up with the Afterpay story, you'll know that's because it doesn't actually make a profit according to accounting standards. Yet the share price has gone well up. So, I guess there are limitations to using this metric. Obviously, if you see a negative number, that's not good. So we have to be careful that we don't just completely rule out a company. Like a really good company, a company that I recommended to our members quite a few years ago was Xero. And if we go to Xero, which is the accounting software company, and full disclosure, I own this company in my portfolio. If we look at Xero, what we actually find is that if you go in here, you'll see that things like return on equity, return on investment, they're very, very low at 1.3%. And so if we were trying to use a quantitative method, so using numbers to try and identify a moat within a business, it actually becomes quite difficult because you miss some companies that don't yet have that return on invested capital. They might in 3 or 5 years, but they don't today. So one of the things that we've got to be mindful of, firstly, is the way we calculate return on invested capital which is operating income, or EBIT. Basically, I'm just using some round figures here. EBIT adjusted for tax divided by total capital. And that tells us effectively how efficient the company is as deploying capital. Now let's go to another business. Let's say Apple. So what we can see in here is the return on investment for the trailing 12 months for Apple, this is another company I own, by the way, full disclosure, is 39%. So this is incredibly good. This return on investment is very, very high. And so if any of us, we don't even really need to know what a competitive advantage is, but we probably know that Apple has one just because its return on investment is very high. And even over, whereas the last 5 years, it's still 22%, which is very strong. Now, so how does this have anything to do with competitive advantage? Okay. So the thing to remember here is that I'm just bringing my chat up so I just don't miss any conversation. The thing to remember here is that according to traditional economic theory and capitalism, when a company has a really strong business or idea, competitors will come in and try and challenge its moat. And it's what it is doing. So for example, if we have an iPhone, we could also substitute that with the Samsung Galaxy. But why do people pay more for the iPhone? There's obviously a reason. And so that reason is basically Apple's competitive advantage. Rusty says, is this the man behind the voice of the Australian Finance Podcast? Yes, it is, Rusty. I'm that guy. I'm also the guy behind the Australian Investors Podcast, if you follow that one too. So what we have here is Apple has a very strong return on investment. Now, this is going to make sense in just a minute. I'm going to tie these two things together. So we have capitalism, which tells us over time, this should come down because competition should enter the market. But for some reason, Apple still has a really high return on investment. So how does it do that? And the answer is it has a competitive advantage. So some of the competitive advantages that we know exist in the market are things like intangible advantages, so brands. So there's this joke that if anyone here has ever bought a Tiffany, are you going to touch on today's blip from David? I will touch on something. So there's this joke that if you've ever bought a Tiffany diamond, right, you spend, let's say, for example, you might spend $15,000 or $10,000. Let's say $15,000 on a Tiffany diamond. And there's the joke that if you buy a $15,000 Tiffany diamond, you get a $10,000 box. And the idea is, zoom in a bit, sure thing. And so the idea is that the $10,000 is basically just what you pay for having the Tiffany brand on your diamond ring. But what you're actually getting is a lower quality diamond, but people still pay for it. So that's an intangible competitive advantage. We have a business that has, I guess, a brand that people are willing to pay excess for. So that's why companies can do this. Apple, for example, you have Apple, you have a strong brand in Apple in the iOS ecosystem. I've got my iPhone right here. I'm recording this on an iMac. I've got my Apple Watch in my hand. For those of you that listen to our podcast, I talk about Apple a lot, but it's a good example in this case study. I'm willing to pay more. And so that's one source of competitive advantage. Another source of competitive advantage is something that we call efficient scale. And we can probably lump in here, we could probably lump in, say, Sydney Airport, which, as many of you will know, was the subject of a takeover offer recently. And if we look at Sydney Airport, the metrics are pretty bad for the past 12 months because, it's been pretty tough for travel lately. But if we look at a business like Sydney Airport, what we can actually find, I'm going to use return on equity here at 51%. What we actually find is that you typically only need one international airport in a major city that is the size of Sydney. So that's what we call efficient scale. It is the biggest airport in the land, for Sydney. So therefore, you probably don't need another airport. So a competitor's not going to come in, spend billions of dollars on a new one, and then, go from there. Yeah, so DH says, so true about Apple, it's all marketing. Yeah, it is. It's in the marketing. So, yeah, Apple's a very efficient hardware device, but it's actually the true competitive advantage of Apple is actually in its software and its ability to market to you and say, how pretty is this piece of technology that I have? It's really, if you look at comparable metrics across most devices, Apple doesn't really win. Anyway, so Sydney Airports is also a business that has a competitive advantage. It's just got a different type of competitive advantage. So that's the second one. We've got efficient scale. Competitors don't need to come into the market because it's already big enough. Now let's go to BHP. So if we scroll down on the SelfWealth platform to BHP, we look at management effectiveness again. And here we'll look at return on investments over the past 12 months is 15%. And we'll look at, for the 5 years, which is 10.6%, let's say. So here we can see that BHP, even though it is an enormous business, it's earning a tremendous return on investment. And that's because one of the things that BHP does is it digs up iron ore and then sells that, typically to China. And BHP has a cost advantage over its competition. So even like Fortescue and Rio Tinto and even Vale in South America, BHP can produce a ton of iron ore for, I think it's nowadays in the teens. So the actual cost to dig it up is in the teens, but the price of iron ore is much higher than that. So it earns more than it costs. And if the price of iron ore falls, which it could do in the near future, what we're going to see is the lowest cost mining companies like BHP survive. So BHP has a cost advantage because when everyone else in the industry is faltering, BHP could survive. Another one, which I've got on my list, is the network effect. So we all know Facebook. This is another company I own shares in. Jesus, this is becoming a recurring theme. So we all know Facebook is the social media giant. If we look at Facebook, we can see that its return on investment is 27% for the past 12 months, and over the past 5 years, it's 22%. So here, we already know that's a pretty strong number. As we know, Facebook is an enormous company. It has a market cap of over $1 trillion, yet it still achieves super high returns. And the way it does that is it has a network effect. It's so much more valuable to use the Facebook platform because it has over 3 billion users than it is to use another platform, at least for marketing. I don't know about you guys, don't know how much you go on Facebook. I don't go on there that much, but it makes sense. Another website that would have a network effect is YouTube. Every month, over 2 billion people tune into YouTube videos, which is bigger than, I think, every broadcast or direct TV broadcaster in the world combined. So YouTube has a network effect. There's another competitor in the market called Vimeo, which was owned by IAC, but it's a business that can't compete against YouTube just simply because it doesn't have the network effect. There's not as many people using it, so therefore it's not as popular. The final thing that I'll talk about with you guys, and I'm giving away a lot of great companies to add to your watch list today, if I do say so myself, which is Xero, the company that we just spoke about. So Xero is the accounting software company. If we come down here, Xero is a company that provides accounting software to accountants, which then they use for their clients. And Xero is now the biggest in Australia, and it's growing in the UK, dominates New Zealand, it's got some South African business units, etc. The thing about Xero is once you start using Xero, it is very, very hard to give it up. Our business pays less than $100 a month to use Xero, and it would probably be the last thing that I give up, because basically having Xero means that I don't have to pay an accountant, for 5 hours a month to run over my business and make sure everything's ready to go. Caroline says, so not true. So Caroline, if you're in the chat, tell us what you mean by so not true around that comment. I'd love to know what you think and where you disagree. I love respectful disagreement, guys. So if you have something to challenge me on, I would love to hear it. Cameron Riley says, I'm pretty sure Warren Buffett doesn't have any secrets of investing. He's been telling everybody who will listen how he does what he does for 60 years. Absolutely, Cameron. Cameron, I feel like I know your face from somewhere. If you want to jump in the chat and let us know, let us know. So John says, hi, Owen. In any given day on the ASX, few/some companies will go higher than others. what or who determines what companies go up higher than most? John, the answer to that question is pretty simple. If a company releases news, or if there's some sort of outside news, like an article written on the internet or something like that, it's just driven by supply and demand. So if there are more buyers of a company's shares, the share price typically goes up. If there are more sellers, the share price typically goes down. So that's pretty much what drives it in the very short term, and that's how prices are calculated. You can actually go to the ASX website, and they have some documentation on how prices are calculated. And so this is great thing here, just on the SelfWealth platform while I'm here. It actually shows why people are buying things and why people are selling. And this might provide some insight into longer term trends around why things happen. And so anyway, so we've got 5 sources of economic moats or competitive advantages. Let's just recap them. We've got intangibles, so like brands, licensing, regulation. So we said Apple has a competitive advantage with intangibles. It's got a strong brand. We talked about efficient scale. So there's only one major airport in Sydney. Cost advantage. So BHP has in its iron ore division, it and Rio Tinto, the lot of them have the lowest costs. So that is a brand that is a competitive advantage. Switching costs. I talked about Xero here as being very hard to kind of rip out that software once you've got it in your business. And number 5, we talked about network effects, which was Facebook, which obviously the more people that use a social media platform, the more valuable it becomes. So Craig and Sarah Redford asks, what about Dubber? Do you think that has a good moat? Craig, I don't know if you follow me or not, but this is an interesting business and it kind of strikes close to home. So Dubber, which is, for those of you who don't know what Dubber does, Dubber, interesting name, it actually does basically voice recording. So, and then it runs artificial intelligence over the top of that. So it basically works with most carriers. So for example, if you're on a Telstra network and you work for a big company, that company can use Dubber to record your calls for like compliance, or if you've ever heard someone say, this call will be monitored for training and assurance purposes, or something like that. That could be recorded by Dubber, and then that could be analyzed. Dubber also works now with things like Zoom and Cisco's WebEx, so you can use Dubber in that respect too. So do you think Dubber has a good moat? That's the question from Craig. So the answer is, I don't think it has a good moat yet, Craig. So yet is the key phrase, right? So if you go back to the start of the conversation, I talked about how, what do we go down? Why don't we go down here? So if we talk about, companies that have high returns on invested capital, that means that they're going to compound shareholder wealth quickly if they're investing it effectively over the long term. But sometimes businesses have to get to that point, which takes many years before we see that metric appear in the numbers. So what we have to be mindful of is that companies that are in the growth phase, like Dubber is, it may not yet show those financials in the statements. So when I looked at Dubber and I looked at the competitive advantage it could have in the future, what I thought about was switching costs, because once you install Dubber software and you start recording with it, it's pretty hard to give up. And the other thing is probably efficient scale. So once it reaches scale, it's already reaching, I believe, over 100 carriers and channel partners around the world. But once it gets to that, it actually gets to a point where it becomes the default for most organizations to use. Because it's so good, it could be the best. Therefore, why would you use something else? And that is an example of efficient scale. Even though it's different to an airport in Sydney, it still has that that same feel about it, where it gets so big that why wouldn't you use it? There's no reason to use anyone else. And that's what we call efficient scale. Dubber is not there yet, Craig, in my opinion. I don't think Dubber is there yet. However, I think it is a business that could have a moat in the future. So we're investing forward into the future. Okay, so Chanda asked us quickly about TechnologyOne. Let's just have a quick look at return on investments for the last 12 months, 45%. For the past 5 years, the return on investment is 33.8%. So this, again, is a business that, if you think about all of the money inside TechnologyOne, whether it's debt that it's using or whether it's cash in the bank and it's investing, it's compounding money very fast. And if we look at the chart for TechnologyOne, I'm not sure, but I suspect we'll see a very good, performance over the long run. And so indeed here, over the past 10 years, we can see that TechnologyOne has grown in value quite substantially. So all of this is leading me to tell you that if a company can compound its money over the long run, undisturbed, eventually that company will be worth more, because it makes sense, right? If you're a company and you can get a 30% return on your money, why wouldn't you just keep on investing and getting 30% back every year? That's a tremendous return. And then eventually you'll get more and more cash in the bank and the value of your business would go. No worries, Craig, you're more than welcome. Happy to chat about Dubber. So, and I should mention on Dubber, just quickly, Craig, there are a lot of risks with Dubber. It's not out of the woods yet, and it's making a lot of acquisitions. So keep that in mind. It's probably one of the higher risk growth companies on the ASX, in my opinion. That's just my kind of general opinion. I think it's actually a business that is very high risk, but maybe very high reward. It's made a lot of acquisitions, which I'm kind of not thrilled about because it makes looking at the financials pretty difficult. So keep that in mind too. I don't want to be like really bullish on the company. I just want to make sure that you're aware of some of the risks. Okay, so TechnologyOne, it's not a surprise that if it's been compounding its capital for shareholders at 30%, I'm not surprised to see its chart going up because the business is becoming more valuable. The important thing to remember though, and this is what a lot of new investors miss, is that even though it has a higher return on invested capital, that does not mean the share price will go up from one year to the next. It does not mean that. It means that over time, it becomes more valuable. As Ben Graham, Warren Buffett's mentor, said, in the short term, the stock market is a voting machine. So if you look at Dubber, it's very popular at the moment. But in the long run, it's a weighing machine. It weighs towards the companies that tend to compound very well. So this is a discussion of competitive advantages. What I would encourage you all to do now is when you go onto your watch list inside SelfWealth, is go in and look at the companies on your watch list and determine whether or not you think they have a competitive advantage by looking at that return on invested capital, or what it is about them in the future that will make them have a moat, I guess, have a competitive advantage. So Chanda, just in terms of TechnologyOne, it's very similar, I would say, from a moat perspective to Xero, because TechnologyOne offers enterprise software and deep technology expertise for companies, and TechnologyOne deeply embeds its products into the customer's life. So it's very hard to take them out. So I would say it also has a high switching cost, which is like its competitive advantage. Lateef, you asked about, what did we ask here? About Strategic Elements, which is a pool development fund. I actually spoke about Strategic Elements on an investors podcast, Australian investors podcast, about 2 weeks ago. But basically, Strategic Elements is a pool development fund which gives it certain tax benefits in the short run. Strategic Elements is, in my opinion, very small and very risky. So just take a look at what they're actually investing in, get to know the management team strategy and investment process. It's not a company that I follow that closely, to be honest with you. Okay, so Axay asks about, can you please cover Wesfarmers? Yeah, so I'll cover Wesfarmers in just a minute, but Wesfarmers is very similar to what we're talking about today, which is another company called Solpats. Okay, so we've talked about moats. Go away and think about the competitive advantage or moat that your company might have. There's actually a fantastic book. It's called The Magic Formula. Great book on moats, so / advantages. So the Magic Formula is a book that kind of takes you through. It's a really short book if you're interested in like just quick reads. It takes you through why companies that have high returns on invested capital tend to perform well, and it also combines that with a valuation principle too, which is pretty neat. So you get kind of the high quality investing company focus, and then you get the valuation criteria to go with it. Okay. So when we find a company that has a high return on invested capital, the reason that's important is because one, if it's consistent, it means that basically you can keep competition out. And two, you can compare that to the cost of debt for a company. So you can compare how much it makes versus how much it costs to get that money in the business. And it's quite a deep topic, but we'll cover that in just a moment. The next thing I want to talk to you about is assessing management teams. So I'm just going to switch over here to this, which I'm hoping you can see, even though it's kind of through the lower third there on the web page. Let's see if we can go up a bit, maybe. It doesn't look like it's going to help us too much. I'll zoom in a bit, and then we'll go through one at a time. Okay, so basically what we have here is, I think it's called like a Venn diagram, and this comes directly from Warren Buffett, but also from a few other thought leaders like Shane Parrish from the Farnham Street blog. And what we can see in this little diagram here is basically the 3 ways you can assess a management team. So like a CEO, anyone really. And this is going to apply to Washington H. Soul Pattinson in just a sec. So here we can see that if you can find a management team with energy, that's this one right here, talent and integrity that has all 3 of those things, it ends up here in the middle, you're probably going to be in the company of a good management team. So before we talked about companies with high returns on invested capital. Now, if you think about a horse race, we're coming up to spring, so those of you that are interested in the spring carnival, if you think about a horse race, in a competitive horse race, sometimes it's better to think about the jockey than it is to think about the horse. So in this case, what we are talking about is having a great horse when we talk about invested capital. If your company is capable and growing and fast and agile, that's kind of the horse. But if you think about the jockey, the person that's pulling the reins on that horse, you want them to be good too, because that's going to give you the best opportunity to find companies that can grow for a very long time. So the way I look at it at Rask is I want a CEO and a management team to have these 3 things. Now, Warren Buffett was pretty clear when he said that you don't want a CEO or the manager to have lots of energy and lots of talent, but no integrity, because talent plus energy probably without integrity means that you're going to be taken for a ride. And energy and integrity, but no talent, means that you're probably not going to go anywhere. If they don't have talent, how are they going to do well? And if they have integrity and talent, but no energy, then no one is going to follow them. So what we need is an equal combination of all 3 of these things. And I put some dot points here just below the title so you can see what I would look at if I was looking at a company. So here we can see, the little book that beats the market. Yes, sorry, that's the book. That's the book, John. So what John said, that's the book. The little book that beats the market. That beats the market. That is the book you want. So let's just bring that up here. The little book that beats the market. This is the book here. Joel Greenblatt. It's a tremendous read, and it's super easy to get through. There may even be an audiobook these days. A wonderful book. The other great book on Moats is actually this one here by Pat Dorsey, The Little Book That Builds Wealth. So these are 2 tremendous books. Have a look at them. They're probably, they're only $20, $30. Really good reading, really good resources. Yeah, cool. Okay, so here we go. So on the energy side of things, the way you can think about this is by looking at the incentive structure of management. So when you go into the annual reports, you can look at the way they present in investor calls and conferences. I actually saw and listened to an investor call from Dubber, and in the call, the CEO said he was asked about the margins of the business, how the profit margins should go over time, and he said, "Oh, I don't think any CEO on the ASX would talk about their margins in this detail." And I thought to myself, that's a very strange thing to say. Of course, the CEO is going to talk about their margins. That's what shareholders want to know. So the shareholders deserve to know, and you should explain how the margins go. So that's a little clue to me of where that CEO's energy and enthusiasm may lie. If they're not willing to explain how the business, how its financials work, well, that's a key element to being a CEO of a public company. So candor is something that I always look for. Incentive structure, are they paying themselves lots of options? Do they have, skin in the game, which we'll get to down the bottom here, and employee reviews. So I'm going to bring up this little thing that I've been through a few times around the traps. But if we talk about Seek companies and we talk about a company like Telstra, that's terrible. But you can see my spelling got us to where we need to go anyway. You can use the Seek website, which you may know as the HR and jobs website, to actually look at what it would be like to work at a company. And so here we can say, what are people saying about when they work at Telstra? It gets a 3.4 out of 5, which is good, but it's not great, but it's good. And you can see that 85% of employees rate their salary as high or average, and only 61% would recommend them to a friend. Okay, that may be a little bit concerning. Why would only 61% of people recommend it to a friend? And if we look at Commonwealth Bank here, we can see it's 64%, so it's a bit higher and it ranks a bit better. So this tells us about the culture that a company is fostering. If we look at the US companies, we'd go to something like Netflix, and we could see, we can't get past it, but actually what we would see is that Glassdoor has a very high rating for Netflix at 4.2 out of 5, which is very, very high. So that's one way you can look at him. You can get an insight into how a management team grows the business. Over here, we have talent. And so what we're looking for here is the track record of management, Googling them, finding out information about them, looking at their experience and their CV, and also making sure that they hang around at companies. Because a lot of CEOs come in and they kind of change CEOs, as they're called, and they come in for a year or two and then they bugger off with a big bonus. We don't want that. We want them to hang around and see their plans through to fruition. Finally, we have integrity. I'm just going to be a bit quicker now so I can get to Solpats. So corporate governance, we want to see, one of the ASX listing rules is that you have a corporate governance policy and that your board of directors can provide oversight, for the CEOs. Next up, we have skin in the game, which I'll talk to in just a moment. So this is about making sure that the CEO or whoever runs the company actually owns shares in the company that they run. I personally I don't think I've ever invested in a company, or maybe back when I was first starting, but the CEO must have shares in the company that they run. It's as simple as that. They have to, because why would I be investing in a company that they run if they don't invest in the company that they run? So I'm looking for all of these three things. These are hard things to get your head around, by the way, guys. This is not easy stuff. This is why analysts are paid the big bucks to make judgment calls on management teams. And this is the stuff they don't teach anyone at university when they study finance. And it still perplexes me to this day, because investing is as much about psychology and behavior as it is about numbers and money. That's the reality. When you hand your money over to a company by investing in them, you're effectively saying, here, Mr. or Mrs. CEO, you take my money and invest it in the company and compound my wealth. Did the Hot Rock CEO own shares? Yeah, Stuart, that's probably one that probably didn't. So Hot Rock was one of my worst investments ever. And I convinced my mate to buy some shares, and I bought some shares for my mum. This was back when I was just starting at the very first kind of year of my investing. And I actually did a full podcast on this, on the Australian Investors podcast with my friend Ryan, and who now works at the Motley Fool. And that was a disaster. So I didn't follow this formula. And that's what got me caught out. So good on you to point it out, Stuart. This is a counterpoint. If, this isn't the holy grail to investing, but it will teach you how to identify management teams that are high quality. Okay, so back into SelfWealth, we're going to jump over and we're going to talk about Washington H. Soul Pattinson. So we're talking about this dividend compounder for SelfWealth live number 5. So this is what I like to do. As I explained last week, I like to use the watch list as kind of a way just to add notes for myself. So I think it was Netflix where I put a note in here to myself saying that I covered Netflix in the September 6th SelfWealth. I'm looking to do more research into Disney's growth and Apple's market share. I was supposed to say before buying shares. And so I've added some notes here, and anyone can do this just on their watch list page, which I think is a cool feature, just to add a quick note and a reason why you're adding it to your watch list. Okay, so just maybe answer a question as we get into this. Here we go. Zoom out a bit here and here. Zoom out a bit here. Okay, so here we go. We've got LT asks, Owen, usually when companies do cap raisings with share purchase plans, shouldn't the stock price go down due to dilution? At what condition does the stock price, under what conditions would the stock price go up? ABB is up since the share purchase plan announcement. Yeah, so sometimes when a company does a share purchase plan, Aussie Broadband in this case, the share price goes up, right? And then what happens is you think that because they're selling shares, they're offering shares at a lower price, why don't shares fall to that price? And one of the reasons is just basically supply and demand, because the company is so in demand and people want to own its shares that the little bit of dilution that comes from doing a capital raise doesn't actually affect it. So that tends to be what happens. Okay, so let's look at Washington H. Soul Pattinson & Co. So this is, I think it's the ASX's longest running listed company. So it's been listed on the stock exchange, I believe, for over 100 years. And it's paid a dividend for many, many decades without fail. So this is a business that is known for its dividends. And you can see most people buying the stock inside SelfWealth are saying they're buying it because they think it's a good dividend stock. They're probably the one that's also noticeable here is that they say the stock is undervalued. People selling it say they're taking profits. And the next one is the opportunity cost, so having a better investment idea. And so if we come up, let's just have a quick look at the ratios. So this is, if we go management effectiveness. So return on investment is 16.7% here, which is pretty high. And we can see over the past 5 years, it's 10.4%, which is not that high, but still decent. If it's in double digits, a return on investment in double digits over 5 years is probably pretty decent. I actually did a podcast with the CEO of Washington H. Soul Pattinson, Rob Milner, not too long ago. Actually, I interviewed his whole family, basically, throughout the Investors podcast, and it was great to chat to him because he told me so much about his history and the family's legacy and how they built this business. Okay, so if we look at the news and announcements tab, we're going to talk about basically how Soul Patts has earned itself such high returns and basically kind of what's going on. So the first thing to know about, I should just use the filter up the top here. I just want market sensitive announcements. So here we go, merger presentation. I will download this to make it easier for you guys to see. Save that, bring that up. And then we'll go back out here and we'll go the half year results presentation. Let's download that one. Yep, bring that one up. Okay. So John says Brickworks is heavily invested in Soul. Yeah, so Brickworks is heavily invested in Washington H. Soul Pattinson, and Washington H. Soul Pattinson is heavily invested in Brickworks. And as you probably know, John, that relationship is very, very contentious. So some people and some organizations in Australia have taken Brickworks and Soul Pattinson to court to try and get their holding overturned. That is a real thing. Yeah, so people actually think that it's not fair that Brickworks owns so much of Soul Patts and Soul Patts owns so much of Brickworks. I actually also interviewed Lindsay from the CEO of Brickworks to understand how he invests at Brickworks and how that relates to the way Rob Milner and his team invest at Soul Pattinson. And so it's a really interesting it's a really interesting thing if you're new to investing, kind of tracing back how these companies are intertwined. What you actually realize is that these companies own a lot of companies. So there's a lot of, I guess, power in Australia owned and tied up in a few companies, which is really interesting. Okay, so let's get to it. Washington H. Soul Pattinson here has a diversified portfolio. So if you buy shares of Washington H. Soul Pattinson, what you're actually getting is you're buying into a company that buys other companies. But this company isn't really like a listed investment company. It's a little bit different to that. It's actually a company. It owns businesses outright, but it also makes investments to private companies, into property, and into listed companies. So a big holding of Washington H. Soul Pattinson is TPG Telecom. Another one, as John said, is Brickworks. Adam, everybody owns everyone. Yeah, that's about it, right? Thanks, Alex. These live videos are really cool. Wonderful. Sounds like the car industry, says Adam. Yeah, totally. So New Hope Corporation, which is the coal mining company, it's got a diversified financial services business, which is basically a bunch of like funds management businesses and businesses that they own either partially or outright. They've got the pharmaceutical portfolio, which includes Australian Pharmaceutical Industries, or API, and that's where this conversation will relate to Wesfarmers. Wesfarmers has tried to buy one of the big assets that Washington H. Soul Pattinson owns, which is API, and Round Oak Minerals, which is a minerals and mining business. They've got obviously listed equities, so they can invest in companies on the ASX as well as a private equity portfolio, and the list goes on. So basically, the way you look at Soul Pats is totally different to the way you look at a normal company, because what you're getting is not one company, you're getting a basket of companies. This is kind of like before there was ETFs, this is what you would buy. And so Soul Pats has done a tremendous job. So let's go down just a little bit further. So you can see that since 2001, Washington H. Soul Pattinson stock, including dividends, has gone up by 13.6% per annum. That's compounded. And so you can see over the time how much better Soul Pats has performed relative to the index. There are some kind of idiosyncrasies here that you want to take note of, but that's just kind of the high, level, I guess, go at it. You can see that the company also gets sold down pretty heavily at times. Kind of like the Berkshire Hathaway of Australia, says Mark Jonas. Yeah, kind of. Yeah. DH says these live videos are the best thing about Monday. Well, DH, I'm thrilled with that. I'm absolutely thrilled. Thank you for joining us. I love that. Thank you. So long-term shareholder returns, you can see $1,000 invested in 1981 is worth 200,000 clams today. That's pretty impressive, and a compound annual return of 14.2%. So obviously, Washington H. Soul Pattinson, through its ability to invest in other businesses, has done a very good job. Personally, I'm not a fund manager, but if I ever was, the way I would do it is have a company to invest that money. I wouldn't be an outright fund manager. Don't tell any of the people that I interview on the podcast for that, because that would kind of maybe tickle them the wrong way. So here we can see that dividends, you can see the interim dividends. This is a half-year report, so we're talking about interim dividends. And you can see the dividends increasing through time. Pretty incredible. Okay, let's jump back out. Let's go back into the general kind of page for Soul Pats. So here we go. We can come back to the page. We can see revenue. We can see EBITDA, or earnings before interest, depreciation, amortization, etc. We can see dividends for the past 12 months. We can see the profit and the market cap. Now, you can see here that the numbers look really, really good. So let me just point this to you. See how the price to earnings ratio for Soul Pats is only 9, which some people think is very low, but the dividend yield is also quite low. What you need to be mindful of here, guys, is that with a company like Soul Pattinson, the profits are calculated differently to if you were looking at, say, Xero. With Xero, you're buying the company and you're seeing the profits from that one company. So, they've got costs, they've got expenses and all that sort of stuff. But with Soul Pattinson, the business actually uses something different. It's called equity adjusted accounting. And this effectively adjusts for the value of each of the investments inside the portfolio. So it's a really, really, really interesting thing. So it basically means that when Soul Pattinson records profit in its income statement, it's recording the value of its investment in that other company, not what actual profit it made from its operations. And that accounting formula only applies to certain businesses that it owns. So one of those in the past was TPG Telecom, but now it's different altogether. So now it's not recorded that way. Now it's recorded just based on dividends that it gets paid and its share of those dividends. So what I mean to say is you should be focusing on something called regular profit. Well, that's how they record it. And so here you can see that they've got regular profit, which is down 27% for the year, not necessarily the statutory profit, which gets recorded in the databases of things like SelfWealth or other websites. Yeah. So Ben asked, very interesting, Owen, how did the blood donation go last week? Were you dehydrated in the end? No, I was fine. Thanks, Ben. I actually jumped on the line to Lifeblood. For those of you who don't know, I actually got a blood test. Did my blood donation last week, and I was reminded that I have to drink lots of water by everyone on the chat. And fortunately, I was okay. So, yeah, I jumped on the phone and they said, don't worry, you're fine. Just drink a few glasses of water. Okay, so here we go. We've got NPAT for the business, $68 million. There's one final thing that I want to talk about here. Stuart says, so essentially, if a sub-company's share price tripled without any change, it may show up as a huge profit that year if it was a substantial enough part of the profit. Yeah, so basically, Stuart, this is basically, we're talking, I'm doing air quotes, we're talking basically. Yeah, so that's basically the way it works, is equity adjusted accounting. So it's called, this is how it's written, equity adjusted accounting. And basically, we'll get an example. The equity method, oh God, what is this? Advertisement. So the equity method is an accounting technique used by a company to record the profits earned through its investment in another company. With the equity method of accounting, the investor company reports the revenue earned by the other company on its income statement in an amount proportional to the percentage of the equity investment in the other company. So you just want to have to look at, this is probably a US definition, but you just want to have to look at basically how it works. For Australian companies, it's similar. But that's a good question, Stuart. Yeah, so it's basically, like, if you just want to think about it as kind of like a high level thing, it's not the actual profit that Soul Patts is earning from its day-to-day operations. It's basically, how does it account for its equity holding in another company? So net income of the investee company increases the investor's asset value on their balance sheet, while the investee's loss or dividend payout decreases it. So it gets pretty complicated, but there are some great YouTube videos on this, and I'm sure there's one here too. So the final thing that I want to touch on with Soul Patts is that, so other than the way that we kind of look at it, is basically Soul Patts is trying to merge with another massive investment company, which is called Milton Corporation. And if you look, Milton Corporation here has a director named none other than Robert Dobson Milner, or Rob Milner. And if we look at Soul Patts, the company is actually owned by not owned, but managed by Rob Milner as well. So I can't see it here. I'm sure it's in here somewhere. I can't find it right now. But it's managed by the same person, effectively, in the same group. So effectively, they're going to bring together two massive investment companies. And they go through this document and explain why it's a good idea. You know, things like portfolio diversification. I'll zoom in a bit. Additional liquidity, cash generation, dividends, all that sort of lovely stuff you want to hear as an investor. And it obviously requires a few things to get past before they get the deal over the line. But if you're an investor, you would have received a scheme booklet that should outline what actually happens. And so you can see they're trying to bring together two big investing companies to make them even bigger. So they would go, according to this chart, they would go from the number 91 or the 91st biggest company as at this date to the 54th biggest company if they combined. And again, we see that chart from before. We can see the dividends emphasized there. And yeah, this is an interesting move because Washington H. Soul Pattinson is merging with another company that's similar, that does a similar thing to try and get more scale. And why does that make sense? Well, because I'm just going to spitball here. One of the reasons that it makes sense is that as a bigger company, both companies can make bigger deals. So they can go out and they can bid for bigger companies and make more investments, basically. The other thing to be mindful of in terms of Soul Patts recently was it received a takeover off, well, not it, but Australian Pharmaceutical Industries. I'll just get rid of that. Australian Pharmaceutical Industries received a takeover offer, and it will impact Soul Patts because Soul Patts is a major holder of that. So yeah, this is a business that Soul Patts is a business that I've had on my watch list for a very long time. I owned shares back in the day, but the thing to know, and I actually owned it, I think it was in the mid-teens, so I've missed out on basically doubling my money over the past few years. But the thing to know about Washington H. Soul Pattinson, if we go back to our conversation about management, Rob Milner and the Milner family own a lot of the Soul Pattinson business. So they definitely have skin in the game. And if you watch any recordings of their annual general meetings, or you see, how they've been kind of discussed in the AFR or in news journals, you know that they tend to speak with a lot of candor. Corporate governance might be an issue that some people have with Soul Pattinson because it is controlled by a few people. People think that there's not enough oversight. I'll leave that up to you to determine. If you look at, there's no real employee reviews because the company doesn't have that many employees because it only has to invest in other companies. But I would look at incentive structure. One of the things here is that the incentive structure is actually aligned to skin in the game. So if a company's management team has skin in the game, they tend to have incentives that align for the long term. And for talent, if we look at the track record, the experience, and the tenure, we've obviously got that here with Washington H. Soul Pattinson because we know the company has a track record because it's right here. They let us know all about that every time. So in terms of ticking these boxes, that's an interesting exercise. Where does the company fall in your opinion? Does it fall directly here in the middle? Do they have low amounts of integrity, lots of energy, no energy? This is the way, it's just a framework for analyzing it. And then, if we talk about efficient scale, if it combines with Milton Corporation, then it will be one of the biggest investment companies in Australia. And then it might be able to make bigger and better deals. That's, again, up to your interpretation. But that's basically how it fits into our two criteria that we looked at today, which is how does the company invest for the long term, that return on invested capital and its competitive advantage, and also how can we analyze management teams. So that's basically a look at Washington H. Soul Pattinson. So one for the watch list, and you can come back next week. We've got one more week together next week at midday, and we can if you want to ask me questions about what you found with Soul Patts, we can talk about it then. I want to just point one final thing out that I neglected to mention a little while ago. When I did a podcast recently on Australian Finance Podcast, and we named like 10 stocks for a hypothetical portfolio. And I named Soul Pattinson for people that are interested in dividend income. And I actually copped a fair bit of flack because I failed to mention that Soul Patts has a big exposure to coal, which a lot of people took offense to. It's a pretty polarizing thing in Australia right now. So an investment in Soul Patts does include exposure to coal. So whatever your belief is on that may determine how or if you invest in this company. So I just want to make mention of that before anyone sends me an email and says, hey, you didn't cover this. There I did. I just covered it. So you want to make that determination for yourself. The other risks to be mindful of is basically making sure that, Rob Milner is he's getting on now. He's a bit older. He's still pretty witty when I was chatting to him. But he's getting on. So how do they plan for succession? And I guess the other risk is if they are dependent on commodity prices going up, like coal prices and whatnot, as you can see here, Round Oak did better. How does that impact the valuation of the company? So why did I sell Saul Pattinson shares? DH asks. Well, this was quite a while ago. DH, I sold it probably. It probably would have been around somewhere in here. And I think at the time I just sold it for opportunity cost. Maybe I'd made a small profit, but I just started investing differently, to be honest with you. I started investing in companies that are faster growing. So that's kind of where I made that decision in the mid-teens there to really target and put all of my portfolio behind things that are, I guess, higher conviction, faster growing type companies for me. Okay, so just a quick fire before we end. Here we go. Can you do a customized research scan on SelfWealth to pick, for instance, companies that have a high return on invested capital? I don't believe you can do that yet, but I think it's a feature that the team are working on. I'm not sure, Chanda. You can email in to the guys and just see if that's on their engineering product roadmap. What else have we got here? ZipPay. What's your opinion on ZipPay? To be honest, Ashley, I don't really have an opinion on Zip. To be honest, I don't. It's a really interesting business. It's obviously pretty crowded in the buy now, pay later space. I like that they do credit checks and they're actually authorized. But yeah, something to be mindful of. Okay, so the market is on sale, says Jose. Yes, it is on. It is indeed. So let's have a look. Let's go STW. So this is to look at basically how the market is going today, down 2%. Look at that, it's on sale. If you're a long-term investor, why not buy shares today? Okay, thoughts on the new semi-ETF, Rusty? Good question, Rusty. I'm actually covering that in an Australian Finance podcast coming up in the next couple of months. So semi-ETF will be covered there. Have you looked at Australian strategic metals, says Stuart? No, I haven't. Not quite in my area, as you know. It's not really the type of company that kind of gets me out of bed every day. I tend to stick away from mining, to be honest. Yeah, so Ben, you said not a good day on the market. I bought VDHG this morning. Yeah, so I mean, some days are good, some days are not good, but I guess it depends on your opinion. If you're a buyer of shares, today is a good day. If you're an owner of shares, maybe it's not the greatest day. Stephen, I don't know QPM. I'm sorry to say that I don't actually know it. If you want to write in the chat what's so good about it, and then next week we can come back and you can give us an update, that'd be wonderful. Okay, guys, I think that just about does it for us for today. I hope everything went off without a hitch. I'm actually looking outside now in classic Melbourne. It's sunny again. So that's wonderful to go and have some lunch outside. What are the chances? Okay, so Marco says, Washington H. Pattinson holds a lot of companies with exposure to many things. Still comes back to the buyer's research. Absolutely. You want to research what Soul Patts is investing in. So, and full disclosure, I own the VDHG ETF. I did just mention that. Vanguard Diversified High Growth ETF. I own shares or units in that. So again, in reflection, guys, if you want to say g'day, jump onto Twitter with the hashtag SelfWealthLive, _ SelfWealth. You can see all the social media handles there. Don't forget that promo. John says, cheers, Owen. It's a pleasure watching your videos. Cheers, mate. Thanks for joining us. Ben Walker says, but I did buy Playside and I'm confident they're good. Wonderful. Well done, mate. Great business indeed. A very speculative one, but good one, PLY. Wonderful, guys. Thank you so much for joining me. If you want to go onto SelfWealth's YouTube channel, you can subscribe and you'll get a notification for next week at midday. And you can find me on Twitter too, at Owen Rask, if you want to chat. Cool. Thank you, everyone, for joining both Rob and I today. Thank you so much for this. Let's enjoy the day that is a down day and maybe go on the hunt for some shares. It might be a good day for it. Wonderful.